Hello everyone, welcome to the class of Introduction to Finance. This will be our last class for Chapter 7, and also this is going to be the last class for this semester. But before we start, let's quickly review what we discussed before in the third class of Chapter 7. So in our previous class, we discussed what is yield to call and how to calculate yield to call. So it's actually very similar to yield to maturity. The only two things that you have to change is the n now becomes the number of years to call rather than number of years to maturity, and also the future value is no longer the par value but the call price. So if you change those two, you'll get yield to call. And then we also, apart from the exercise, we also discussed what is price risk and the two factors that can influence the price risk. So we discussed price risk is the concern that the changing interest rate, especially the rising interest rate, would cause the value of the bond to fall. If it rises, it's still volatility, but it's not really a risk because you're going to have capital gains. You're only worried about the situation when the price falls, right? So that's price risk. And then we discussed there are two factors that could influence the price risk. The first one is the maturity. We say the longer the maturity of the bond, the higher the price risk of the bond. So long maturity bond tend to have higher price risk. The second factor is the coupon interest rate. So we say the high coupon interest rate could help reduce the price risk because you kind of get proportionally you get more payments earlier compared to the ones with lower coupon rate. If the bond has lower coupon rate, then majority of the payment you get will be the future value when it matures, right? In the end of the day, you get the par value. But if the coupon interest rate is pretty high, then proportionally a bigger part of the cash flow happens before it matures. Therefore, it can help reduce the price risk. So these two factors, maturity increase price risk, coupon interest rate reduce price risk. So that's what we discussed in our previous class. Today we are going to continue discussing the risk of the bond, but we're going to discuss reinvestment risk. The first question we need to answer is, what is reinvestment risk? Reinvestment risk is the concern that the interest rate will fall and future cash flows will have to be reinvested at lower rates, hence reducing income. That's reinvestment risk. It means that the price of the bond will fall, and therefore the interest rate would fall, and therefore when the bond matures, you won't be able to find the same interest rate at that time. Therefore, you may have to invest in the lower interest rates, the bond with lower coupon interest rates, and therefore facing the risk of reduced income. So that's reinvestment risk. In other words, it's kind of like if you don't buy long maturity bond, then you won't be able to fix in or lock in the good interest rate you have right now. So that's basically reinvestment risk. An example here will help you better understand what is reinvestment risk. It says, suppose you just won $500,000 playing the lottery. You intend to invest the money and live off the interest. So there are two strategies for you to invest your money here. You may invest in either a 10-year bond or a series of 10 one-year bonds. So if you do the 10-year bond, you do it once and for all, right? So you invest all your money here, and then you keep receiving interest income every year, and you get your principal back in the end of the 10th year. But if you decide to invest in a series of 10 one-year bonds, you have to do it manually every year. So You first invest your money in the 1-year bond, then you get all your principal and interest and interest payments or interest income in the end of the first year. Then you reinvest money again in another 1-year bond 1 year from now, and then you get back all your principal and interest in the end of the second year. Then you do it again. So you do it like for 10 times. And then, but theoretically, you should get the same rate of return. Otherwise, one is better than the other. Therefore, there's kind of the arbitrage opportunity there. But now we assume both 10-year and 1-year bonds currently yield 10%. So that's why it doesn't make a difference for you whether you should invest in a 10-year bond or 1-year bond, because at least for the first year, your return is the same, right? In the short run, your return is the same. For the first year, you get 10% interest income. So if you choose the 1-year bond strategy, after year 1, you will receive 100,000 in income and have 500,000 to reinvest. But here's the key, if the 1-year rates fall to 3%, your annual income would fall to 15,000 in the second year, right? This is the situation you don't want to. You want to maintain your $50,000 every year from the interest income. So if you choose the 10-year bond strategy, you can lock in this 10% interest rate and $50,000 annual income for the next 10 years, assuming the bond is not callable. If the bond is callable, then the issuing company can call back the bond anytime. Then therefore, you won't be able to lock in this good interest rate. But if the bond is not callable, then you are guaranteeing this $100,000 in the next 10 years. But of course, there's also that risk that if interest rate, instead of falling to 3%, increase to 15%, then you would miss that extra 5%. That would be $75,000. If the market interest rate increased to 15%, you would have been able to get $75,000. But because you bought this 10-year bond, therefore you are stuck with this $50,000 annual income, right? So that's the disadvantage. But at the same time, yes, you could miss that gain if the market interest rate rises, but you also protect yourself from the risk, the loss of the loss when the interest rate goes down, right? So that's the trade-off here. So now we can make a conclusion about the price risk and reinvestment risk. For price risk, we have discussed there are two factors here, the maturity and the coupon rates, right? So for short-term and or high coupon rates, short-term maturity reduces price risk, right? So it's low price risk. And coupon increases, coupon also helps maturity increases price risk. Therefore, short-term bond will have low price risk. Coupon reduces price risk, so the high coupon bond will have low price risk, and vice versa. So the long-term bond with low coupon interest rates will have high price risk. That's what we discussed in our previous class. Just now we discussed the reinvestment risk, and we could draw a conclusion that for long-term bond we could lock in the good interest rate. Therefore, we face low reinvestment risk. Yeah, but for short-term bond we'll face higher reinvestment risk. And if it's low coupon bond, therefore it will have relatively low reinvestment risk because the coupon interest rate is already quite low. Therefore, it has less probability that the market interest rate would fall even further. So that's why the reinvestment risk is low. But if it's high coupon bond, then most likely the market interest rate have like more room to fall, or the market interest rate has more room to be below this high coupon bond, right? So therefore the reinvestment risk is going to be high. So you see, no matter whatever combination you have, no matter whether it's short-term high coupon bond, then you will have higher investment risk, or long-term low coupon bond, then you will have a high price risk. Or you can even mix up, let's say short-term and low coupon bond. Then in this case, if it's short-term, then you're going to have high reinvestment risk. If it's low coupon bond, then you will have high price risk, right? So, and vice versa, no matter whatever combination you make, there's no way you can get the perfect strategy where you don't face any risk. So in other words, nothing is riskless. Risk is inevitable. So basically, price risk or reinvestment risk, you basically have to choose one. So that was the risk, and this part is actually quite important. Oh, I didn't highlight it, but it's important for you to know the combination of this maturity and coupon bond, and you know the dynamics of this risk, the implications of the maturity and coupon interest rate on those risks. The next part is the semi-annual bond. How to do calculations with semi-annual bond. So this is the second topic of today. The first topic is the reinvestment risk. The second topic is semi-annual bond. Then the last one is about the default risk or the bankruptcy risk. But this part, semi-annual bond, is actually nothing new. It's what we studied before in chapter 5 about semi-annual compounding. Here it's just an application of the semi-annual compounding in the bond valuation. So we know that if we do semi-annual compounding, there are three variables that need to be adjusted. The first one is the n. If n is the number of years to maturity, if it's semi-annual compounding, we have to multiply years by 2 to get the number of periods. Now it's 2 times n, right? And we also need to divide the nominal rates by 2. So the periodic rate will be the discounting rate divided by 2. Yeah, because before it was annual rate, now it's periodic rate, the semi-annual rate. And then the third step is to divide annual coupon by 2. So the payment now should be equal to annual coupon divided by 2. Yeah, so these are the three adjustments we need to make. And here's for those 5 variables, you see the value you don't have to adjust because it's the value at a certain point of time, right? So therefore you don't have to consider the difference in the semi-annual compounding or the annual compounding. The present value will be the current market price, the future value will be the par value. Those two doesn't change, so it's okay. But the other 3 variables you have to make adjustment. For n, you times 2. For the interest rate and the payment, you have to be divided by 2. Okay, so, and then the next part is the example question. What is the value of a 10-year, 10% semi-annual coupon bond if the market interest rate is 13%? So we can now calculate that because it's semi-annual compounding, therefore n is no longer 10, it's 10 times 2, it equals to 20. The market interest rate is no longer, the I/Y is no longer 13%, it should be 13 divided by 2, right? And the payment is no longer, if it's 10%, the par value is $1,000, the payment should be $100 per year. But because it's semi-annual compound, we have to divide by 2, so the payment has to be 50. So these 3 are the ones that we have to change. Future values we don't change, it's still $1,000. And now we calculate for the present value, right? So the first step is to multiply years by 2, we get 20. The second step is to divide nominal rate by 2, then we get 13 divided by 2 gets 6.5. Then the third step is to divide annual coupon by 2. So the payment is no longer 100, but $50. Then we put in the future value, which is still $1,000. Then we will get $834.72. So that's the bond valuation with semi-annual compounding. So after calculating the price of the bond for this semi-annual compounding coupon bond, the next question is if there are two bonds, everything else are the same except for that one is annual compounding while the other one is semi-annual compounding. Which one would you prefer? So that's the question it asks here. Would you prefer to buy a 10-year 10% annual coupon bond or a 10-year 10% semi-annual coupon bond, all else constant? So if we look into this question into details, then we will realize that everything else is the same, right? The face value is the same, the coupon interest rate is the same, the maturity is the same. So that means if the par value, let's say it's $1,000, then 10% annual coupon interest rate, no matter whether it's semi-annual or annual, you will receive $100 every year, right? No matter whether this $100 is given to you at once or split into 2 times, like each time you get $50, you will receive $100 every year. The only difference between these two bonds is that if it's semi-annual compounding, you receive $50 in the end of the first 6 months. So let's say in the end of June, and then you receive the other $50 in the end of December. That's for semi-annual compounding. But for annual compounding, you receive $100 in the end of December. So that means the only difference here is that you receive $50 in advance, like 6 months in advance earlier than you would have received if it's annual compounding, right? So in this case, which one would you prefer? Would you prefer to receive the $50 6 months earlier? Of course, right? Who wouldn't? You might think that $50 is too little, but if it's like a big par value, then it's no longer little. If it's like $1 million bond, then 10% or 5% is a lot of money, right? So you can even reinvest that $50 for the 6 months and get some extra interest. So therefore, semi-annual compounding is definitely preferred. We can also compare them using calculations to be more accurate. So the semi-annual bond's effective rate would be, this is the equation we studied before in chapter 5, right? So the effective rate is going to be 1 plus the nominal rate divided by m. M is the number of periods in a year, and then minus 1. So if the interest rate is 10%, then the effective rate is 10.25%. Yeah, and then because the 10.25% is larger than 10%, which is the annual bond's effective rate, so you would prefer the semi-annual bond because it offers you higher effective rate of return. This question asks if the proper price of this semi-annual bond is $1,000, what would be the proper price for the annual coupon bond? Because the semi-annual bond has a 10.25% effective rate, so the annual bond should earn the same effective rate of return. At these prices, the annual and semi-annual bonds are in equilibrium. Yeah. So that means that here tells you the price of the semi-annual bond, right? And asks you for the price of the annual coupon bond. In order to know the price of the annual coupon bond, we already know the par value, which is $1,000. We know the coupon interest rate is 10%, so the payment should be $100. We don't know the PV. That's what we want to know. We know the N that's 10 years, right? And we know the interest, we don't know the interest the market interest rate, but we know the price for the semi-annual coupon bond. Therefore, we know we can use the price of the semi-annual coupon bond to calculate the I/Y, so the market interest rate, and then we use that market interest rate to calculate the PV for this annual coupon bond. Yeah, because for the semi-annual coupon bond, the price is exactly the same as the par value, which means the market interest rate, the I/Y, should be the same as the effective rate of return. Yeah, so therefore the market interest rate should be 10.25%, and that's the one that we're going to use to calculate the price for the annual coupon bond. So, and for the annual coupon bond, you don't have to make adjustment for the N or the interest rate. So everything is annual, makes it relatively straightforward. So N is 10. The interest rate, market interest rate, is the same as the semi-annual coupon bond's effective rate of return because the par value equals to the price. So it should be 10.25, and payment is 100 because it's 10% times 1,000. Face value is 1,000. Therefore, we can calculate the price should be $984.80. Yeah. And then the next one asks a 10-year 10% semi-annual coupon bond selling for $1,135.90 can be called in 4 years for $1,050. What is its yield to call? Yeah, so this one's asking for the yield to call for this semi-annual coupon bond. So it's like combining two topics that we studied before, yield to call and semi-annual compounding. So it's actually not complicated. It's just you have to remember to make adjustment for the semi-annual compounding, and always remember to use the call price and the maturity to call, number of years to call when it comes to yield to call. Yeah. So for this one, yes, the maturity is 10 years, but it's 4 years to call, right? To be called in 4 years. So N should be 4 years. But it's semi-annual compounding, therefore we have to use 2 times N. So N in this case is 8. And now we have to use call price rather than a future value. So call price is $1,050. That's the call price. And then the PV is 1,000. So the price right now is that's the PV, $1,135.90. And then what else do we need? The payment. The payment is 10% for this 10% for the par for the $1,000 is the par value. So payment every year is $100, but it's semi-annual compounding. Therefore, the payment each period should be 100 divided by 2, so $50. Yeah, so that's the 50 here. So the only thing that we don't know is the I/Y, that's the yield to call, and we can calculate the yield to call is should be 3.568. So that's the answer. So that represents, but that's the periodic semi-annual yield to call. Remember, everything now is every 6 months, right? So the period is 6 months. Therefore, we have to change it to annual. So we have to use this result times 2. Then we get 7.137% is the rate that a broker would quote. So the effective yield to call can be calculated using the periodic rate. So that's 1 plus the periodic rate square minus 1, so 7.26%. Yeah, so that's the effective yield to call, and this is the nominal yield to call. That's the difference here. And then the next question is, if you bought these callable bonds, would you be more likely to earn the yield to maturity or yield to call? Remember, we had similar questions before, right? And at that time, I was telling you that if you want to know which yield should you make, you are actually essentially asking whether the company is going to call back the bond or not. And whether the company wants to call back the bond or not depends on depends on whether the company is overpaying the interest payments every year or not. So that's essentially to asking you to compare the coupon interest rate with the market interest rate. Yeah, so if the coupon interest rate is higher than the market interest rate, then the company could call back the bond and then issue a new bond at a lower coupon interest rate, so that they don't have to pay the high interest payments every year, right? So in this case, what is the coupon interest rate? Is 10%, right? And what's the market interest rate? It's 7.137%. Yeah. So in this case, clearly the coupon interest rate is higher. Therefore, the company would want to call back the bond. So they could raise money by selling new bond, which pay 7.137%. So that means they could replace bond that is paying $100 because the coupon interest rate right now is 10%. So you have to pay $100 per year with the bonds that pays only $71.37 per year. So that means investor should expect a call and to earn the market interest rate or yield to call of 7.137% rather than yield to maturity of 8%. So to summarize, when is a call more likely to occur? In general, if a bond sells at a premium, then that means the coupon interest rate is higher than the market interest rate, right? So in this case, a call is more likely, yeah, because the coupon interest rate is higher. Therefore, the company doesn't want to continue paying this high interest rate. They would want to pay a relatively lower interest rate. So in this case, it's more likely to have a call. So expect to earn a yield to call on the premium bond when the price is higher than the par value, and yield to maturity on the par and discount bonds. So here's an exercise question. Assume that you are considering the purchase of a 20-year non-callable bond with an annual coupon rate of 9.5%. The bond has a face value of $1,000 and it makes semi-annual interest payments. If you require 10.7% nominal yield to maturity on this investment, what is the maximum price you should be willing to pay for this bond? Yeah, so this one is asking for the price you're willing to pay for this bond. So that means if you want to calculate the price, that's the PV, right? So we have to know all the other four inputs for the other four variables. So let's see what are the input for the other four variables. The bond maturity is 20 years, right? Is it annual compounding or semi-annual compounding? Oh, it's semi-annual. Make semi-annual interest payments. So in this case, and is it asking you to calculate the yield to? Does it give you the? Is it callable bond? No, it's non-callable. Okay, so that makes it easier. So in this case, N is 20, right? We don't have to do anything. Oh, sorry, we do have to do anything. Semi-annual makes it relatively slightly. You need an extra step to make the adjustment, right? So 20 years times 2, you get 40. That's N. And then par value, face value is the same because it's non-callable. Therefore, this is FV. And the coupon interest rate is 9.5%. So that means you pay $95, right? Yeah, you pay $95 every year, and for every period that should be 47.5%. Sorry, $47.5. So that's PMT. And then the nominal yield to maturity, so this is the market interest rate, that's I/Y, is 10.7%. But now we are doing semi-annual compounding, so we have to use this one divided by 2. So that means this is 5.35 for the I/Y. Yeah, and then yeah, so that's the I/Y. So now we know everything about this bond, and we can calculate the price, right? So the par value is $1,000. That's FV. Coupon interest rate is 9.5%. That means the payment per period should be the coupon rate times the par value divided by 2. So that's 47.5. And then the period per year is 2 years to maturity is 20. Therefore, N should be 40. And the required rate of return is 10.7. So the periodic rate should be 10.7 divided by 2. So that's 5.35. And then therefore we can calculate the PV. Should be $901.80. Okay, so that was the yield. That was the semi-annual compound. That was the exercise question. The last part for this chapter is the default risk, or in other words, the credit risk. So if an issuer defaults, investors receive less than the promised return. Therefore, the expected return on corporate and municipal bonds is less than the promised return. Yeah, so, and the default risk is influenced by the issuer's financial strength and the terms of the bond contract. There are several types of, we can use this to categorize the bonds into different groups. Mortgage bond, debentures. Mortgage bond has some collateral of the house, right? The debentures doesn't have collateral. Subordinated debentures, this is even has lower priority. And then investment grade bond and junk bond. So what is investment grade? That's basically like for those bonds with higher credit ratings. So how high is higher? Basically, we use the BBB or Baa as the last rating for the investment grade. Any bond with a rating below this are called junk bond. So that's based on this Moody's and S&P credit ratings. And the here what I want you to know is the highest credit rating is AAA. No matter which company's rating you are using, it's always AAA. And for the difference between the investment grade and junk bonds, the difference is the BBB. So anything below BBB is called junk bond, or Baa is called junk bond, and anything above is investment grade. So bond ratings are designed to reflect the probability of a bond issue going into default. Yeah, the rest, like factors affecting default risk and bond ratings, other factors affecting default risk or bankruptcy, this part you can just have a look at it yourself if you're interested, but we're not going to go into details of this, like reorganizations. Okay, so that's basically all for chapter 7. Thank you for your attending the class. I'll end the class here.